You're checking your portfolio more often than usual. Individual stocks are crashing, but the index still up 9% in the last 1 year. And that constant checking, that's not discipline. That's bad decisions waiting to happen that might permanently disrupt your portfolio. Here's what most investors don't realize. Nifty 50 TRI delivered around 9% returns over the last 1 year, and 2025 was its 10th consecutive bull run. But it still felt like zero progress because India was amongst the worst performing stock markets globally. This is neither a fear market nor a euphoria market. This is a range bound, highly volatile, and sentiment heavy market. And these markets don't destroy wealth by falling. They destroy wealth by testing patience until you make the wrong move. Today, I'm going to show you 3 mistakes that quietly drain portfolios in markets exactly like this one. Before we look at investor mistakes, let's look at the reasons for the market being range bound currently. First is foreign institutional investors, short may FIIs, pulling out over 1.85 lakh crores in 2025. The main drivers of this massive FII sell-off are weak corporate earnings, India's premium valuations compared to emerging markets, and 6% rupee depreciation in the last 1 year. Second reason for Indian stock markets being range bound is, of course, Trump 2.0 policy uncertainty. Every statement sends ripples through global markets. Third reason for markets being range bound is investors' preference for safe haven assets during macro uncertainty. Gold is at all time highs. Overall, here's the situation. Global capital is cautious, Indian markets are consolidating after strong multi year gains, and retail investors are feeling uncertain and jittery. That's when they ask these questions. Should I stop my SIP and wait for a crash? Should I move to gold or international markets instead? Should I chase that trending sector everyone is talking about? These questions sound rational, but this is where the mistakes happen, which can permanently disrupt your portfolio. Let's look at what not to do in a bear market, one by one. The most important don't is don't stop your SIPs to get more certainty. Stopping SIPs is the biggest wealth destroyer in a sideways or uncertain market. It sounds simple, but still a lot of people will start doubting this advice the moment markets fall slightly or go sideways for a few months. You'll have the itch to stop your SIPs and see where the market goes till there is certainty. I used to make this mistake at the start of my investing journey too. And then I did a full math to understand if I should double down during dips only or simply continue doing SIPs. Let me show you with numbers. Suppose you paused your SIPs in a sideways market like in 2022. You stopped your 95,000 per month SIP thinking let's get more certainty, wait for a correction, and you even get that opportunity to deploy in July 2022 when the market corrected by 7%. Will you be able to deploy the entire 6 months SIP amount in just one go, which is close to 6 lakhs? No, right? You will deploy 2 lakhs out of the 6 lakh to be invested and you will wait and see if the market corrects further. But this is where now the market goes upwards after that and you miss the rally. The 4 lakhs that you didn't invest in the first half of 2022 will never be invested. I know this because I have done this exact same mistake more than once. So I know that practically, even if you know you should have deployed, you end up re-entering the market a few months later with maybe smaller SIP amounts. Re-entering at lower SIP amounts is going to seriously damage your compounding journey. And if for some unavoidable reason you stopped your SIPs and you want to enter the markets again, please do so with the same SIP amount and not some experimental trial amount. So don't stop your SIP in any type of market till you reach your financial goal. Don't sit out of the market just to build an opportunity fund. Some investors might think building an opportunity fund is a better strategy to deploy during market crashes. Let me show you with examples why that is not true. Suppose you left some money in an opportunity fund. Example 10,000 per month for 10 years at a stretch. You wait for an opportunity, and that opportunity even presents itself during COVID. Answer honestly now. How many of you were able to deploy money when everyone thought the world was ending? And even if someone was brave enough to deploy at that time, your returns would not be very different from an investor who continued doing monthly SIPs without disrupting their journey during this period also. Let me show you with real money examples now. I compared two investors over 10 years from 2015 to 2025. Investor A did a 60,000 monthly SIP and stepped up yearly. He never stopped through demonetization, COVID, or bear markets. His total invested amount was 1.04 crores. But final corpus after compounding is 2.04 crores, giving him compounded annual returns of 14.6%. On the other hand, investor B did 50,000 monthly SIP. He also stepped up his SIPs yearly, but kept 10,000 aside every month in an opportunity fund. He even timed the COVID crash perfectly and deployed at the bottom. Investor B's total invested amount is 99.5 lakhs and his final corpus is 1.99 crores, giving him a compounded return of 15.3% annually. But did you notice the paradox? Investor B made higher percentage returns of 15.3% versus investor A's 14.6%. But investor B's final corpus was still 5 lakhs lesser. That's because that 10,000 per month set aside for 10 years became a total of 12 lakhs. This money sat in liquid funds, earning 5 to 6% per annum instead of compounding at 13 to 14% per annum in the market. So, even perfect timing couldn't make up for 10 years of reduced market exposure. I've shown this detailed math along with the Excel sheet in this video. Do check that out after this one. And if you do get lump sum money that you want to deploy, looking at what is the market PE ratio and earnings growth, then also I would highly recommend you to go watch this video. It will solve all your doubts and all the math that I did to finally convince myself to not stop my SIPs and to not really build an opportunity fund. So don't do is don't keep money aside in an opportunity fund for a correction that may or may not happen. Don't 3. Don't over allocate based on what's trending and hot right now, whether it's asset classes or sectors. By the time you notice what's hot and trending because of hype, it's already too late. The problem is retail investors enter at the peak when valuations are stretched and future potential is limited. Let me again show you the pattern with examples. Gold was up 28% in 2020, but immediately after that it gave minus 2% returns in 2021. An investor who put 10 lakhs into gold in December 2020 after the rally got 4% compounded annual returns in the next 2 years and his corpus became 11 lakhs. Meanwhile, 10 lakhs invested in Nifty 50 during the same period would have become 13.3 lakhs despite volatility, giving compounded returns of 15.2%. After 2023, gold started giving modest returns again. And then finally, from 2024 onwards, the rally started, which led to its all-time high levels now. This rise and fall shows that it's highly cyclical and timing dependent. Most important point for us as retail investors is to stick to our asset allocation strategy. Smart asset allocation should happen without a bias of what is overperforming and trending right now. Because when there are some hot sectors outperforming in the recent months, your asset allocation might get overly concentrated on those classes because you would be biased by the recent month's performance. Even sector investing shows similar patterns. It starts with some sector delivering 40 to 80% returns. Then the media covers it extensively. That leads to retail investors' interest, and eventually they invest in it at the top. Now, what happens next? Either there is consolidation or correction of prices. Every sector you pick has cycles like this. Here also, if you invest at top of the cycle when everyone is talking about it, you miss out the majority of the returns. Actually, something similar happens even when you're selecting funds or switching. Please don't select a fund just based on what is trending or has outperformed only in the recent past. Always select funds based on your alignment with the fund manager strategy and the long term performance of the fund. So, don't 3 is don't over allocate to hot sectors based on recent outperformance alone. Stick to your asset allocation strategy without recency bias. Okay, to conclude, markets don't destroy wealth by crashing. Sometimes they do so by testing your patience, by making you doubt your strategy, by making every other alternative look better than what you own currently. If you can avoid these 3 mistakes, you don't need to predict the next bull run. You just need to cut the market noise and focus on your own strategies, mutual funds, and asset allocation. So stop checking markets daily and continue SIPs as it is. Don't hoard cash waiting for the perfect opportunity. And don't over allocate in hot sectors based on latest outperformance or recency bias. I've been guiding and warning about all these mistakes in my previous videos on this channel. Make sure to check them out to build more conviction and clarity around your investing strategies and decisions. If this video helped you bring clarity, then do hit like, share it with fellow investors who need this right now, and do subscribe to the channel so that we can keep building wealth together with clarity and confidence. Thank you for watching. See you in the next one.